Broadcasting from Zoom, this is DRRM 106 News.
Good day Philippines and good day Cebu. This is Ronald Del Serna.
And this is Maneth Kibido giving you the hottest and latest news of the hour.
In today's headline, for national news, common charting patterns. What are they? Charting cycles. What can we do about them?
For international news, principle of reversion of mean. Is this really mean? Elliott wave principle. Who is Elliott and does he really make waves?
And for our local news, annual cycles, other cycles, head and shoulders, not the shampoo, and lots more will be discussed. Let's get to know them. Charting patterns. What are they? For more details, we have Minette here for more info. Minette?
Yes, Ronald. Today, let us get to know the common charting patterns. What are they? How to identify them? And what should we do about them? So let us proceed to the first question. What are common charting patterns? As we all know, there are hundreds of thousands of market participants who are actually buying and selling securities for a wide variety of reasons, such as hope of gain, fear of loss, tax consequences, short covering, hedging, stop-loss triggers, fundamental analysis, technical analysis, and many more. Trying to figure out why these participants are definitely buying and selling can be a daunting process. That is why chart patterns put all the buying and selling into the perspective by consolidating the forces of supply and demand into a concise picture. And as a complete pictorial record of all the trading, chart patterns provide a framework to analyze the battle raging between the bulls and the bears. Most importantly, chart patterns and technical analysis can help determine who is winning the battle, allowing the traders and investors to position themselves accordingly. So let's proceed to the second question. How to identify them? Basically, in technical analysis, transitions between rising and falling trends are often signaled by price patterns or chart patterns. By definition, price pattern is a recognizable configuration of price movement that is being identified using a series of trend lines or curves. When a price pattern signals a change in trend direction, it is known as a reversal pattern, while a continuation pattern occurs when the trend continues in its existing direction following a brief pause. So let us proceed to the third question. What should we do about them? Basically, the answer to this question is very simple. It is because technical analysts have long used price patterns in order to examine the current movements and forecast the future market movements by calculating the target price. This time, let us proceed to the local examples. As we can see, there are 3 examples. First is a Metropolitan Bank and Trust Company, wherein it utilizes the inverse head and shoulders pattern chart, in which this kind of pattern chart is similar to the standard head and shoulders pattern, but inverted with the head and shoulders top utilized to predict reversals in downtrends. This is an inverse head and shoulders pattern. Upon completion, signals a bull market. And lastly, investors typically enter into a long position when the price rises above the resistance of the neckline. Second example is the San Miguel Corporation, wherein it utilizes the cup and handle, in which this kind of chart pattern is a bullish continuation pattern that is used to show a period of bearish market sentiment before the overall trend finally continues in a bullish motion. The cup appears similar to a rounding bottom chart pattern, and the handle is similar to a wedge pattern, which is basically explained in the next section. The last example is a To Go Group Incorporation, wherein it utilizes the double bottom chart pattern, in which this kind of chart pattern indicates a period of selling causing an asset's price to drop below a level of support. It will then rise to a level of resistance before dropping again. Finally, the trend will reverse and begin upward motion as the market becomes more bullish. This is Maneth Kibido reporting live. Back to you, Ronald.
Thank you, Minette. Up next, chart cycles. What can we do about them? Here is Ronah for the update. Ronah?
Yes, Ronald. Today I will be reporting about chart cycles. What are they and what can we do about them? Today, we will be identifying what chart cycles are, what we can do about them, and we will also be seeing a sample illustration using Philippine stocks. Let us start with our first key point, definition of terms. Let us first define what a cycle is. By definition, a cycle is a series of events that are regularly repeated in the same order. Referring to a chart cycle in relation to stocks, we define this as trends and patterns in the market that can be predicted and tracked based on past performance. An evident feature about these cycles is that they consistently move and behave in similar ways and phases. Speaking of phases, there are 4 phases or stages of this cycle. First, we have the accumulation stage, which starts at the end of the previous cycle when the market has leveled out and it's low and some investors begin to buy again. This is usually when traders and investors begin to accumulate stocks at low prices. Second, the markup stage. This is where the stock market moves towards stabilization, begins to trend upwards, and increases in price. This is when traders become more assertive and begin to purchase more shares as the market is becoming stronger. Third is the distribution phase. This is when the stock market reaches its peak and some traders begin to sell their shares to exit. The market here is usually bullish. One thing to remember here is that there is an increase in volume of stocks, not an increase in price. The last stage is the decline stage, wherein the market begins its downsizing and stock prices fall. This is when many traders begin to sell their shares, but there are not enough buyers, causing prices to decline and therefore the market to decline. Many investors tend to panic and sell, so it is important to remember as a trader that this phase doesn't last forever. Here is a simple illustration of the stages to help you with your understanding. To understand further, here is an example of the famous Jollibee Food Corporation showing forecasts on its daily closing stock price. As you can see, around 2014, accumulation stage has begun. To recall this stage, this is when market has leveled out at its low. Then, in between 2014 to 2015, we can see the start of the markup stage, wherein the stock begins to trend upwards. By 2015, we have reached the distribution stage, where we have reached the peak of the cycle. Then, towards the end of the year, we can now see the decline stage, where the market begins to downsize. As you can observe from the succeeding years, this cycle will be repeated starting from the accumulation stage to the declining stage. Another key point in my report is what can we do about these cycles? Well, we can use chart cycles for many different reasons, but mostly to predict the stock market. It can help us locate times when one should focus on the stock instead of sitting and watching all day. It also helps determine when it will be a good time to buy the stock by looking at the valleys or to sell by looking at the peaks. Chart cycles can also help traders plan when price is going to reverse based on the prior cycle. This has been Ronah reporting live. Back to the studio.
Thank you, Ronah. Next is the principle of reversion of mean. Is this really mean? More about this when we return after our short break.
What's another story to hear? What's another laugh or two? What's another tick on the clock when it's magic shared by you? What's another smile to give? What's another kiss or two? What's another line to say when it's love shared by you? A cup in hand, you know it's worth your while. A cup in hand, can you just stay for a while? Let minutes turn to moments.
But I think I don't need coffee anymore.
Why?
Because seeing you makes my heart palpitate.
It all starts with a Nescafe.
Audio Jungle.
We're back and you're still watching DRRM News 106. Principle of reversion of mean. Are they really mean? For more details, we have Ronah. Ronah?
Ronald, that is a good joke, but principle of reversion to mean does not talk about anything related to being mean or not. By definition, principle of reversion to mean or mean reversion suggests that asset price volatility and historical returns eventually will revert to the long-run mean or average level of the entire dataset. In simpler words, it involves retracing any condition back to a previous state. So, any price that strays far from the long-term norm will again return, reverting to its understood state. Now let us learn the use of this principle. We can use this as part of a statistical analysis of market conditions and can be part of an overall trading strategy. It applies well to the ideas of buying low and selling high by hopefully identifying abnormal activity that will theoretically revert to a normal pattern. Furthermore, in using this principle, traders will try to capitalize on extreme changes in the pricing of a particular security, assuming that it will revert to its previous state. This theory can be applied to both buying and selling, as it allows traders to profit on unexpected upswings and to save on abnormal lows. But of course, there are limitations to this principle. Firstly, the return to a normal pattern is not guaranteed. This is because unexpected highs or lows could indicate a shift in the norm. Such events could include but are not limited to new product releases or developments on the positive side or lawsuits on the negative side. Another is that asset could experience a mean reversion even in the most extreme event. But as with most market activity, there are few guarantees about how particular events will or will not affect the overall appeal of particular securities. This has been Ronah reporting live. Back to the studio.
Thank you, Ronah. Next is the Elliott wave principle. Who is Elliott and does he really make waves? More information from Dana. Dana?
Yes, Minette. That was funny, but no, we are not talking about Elliott waving here. The Elliott wave principle is named for its discoverer, Ralph Nelson Elliott. He noticed that there was a specific pattern of waves that appeared again and again in the stock market. This pattern of waves is what we call as Elliott waves. Elliott believed that stock markets generally thought to behave in a somewhat random and chaotic manner, in fact, traded in repetitive patterns. Elliott wave principle is based on the idea that stock markets and the prices of instruments move in a repetitive patterns. These patterns are correlated with the psychology of the masses and the way investors perceive exterior factors. One of the easiest places to see the Elliott wave principle at work is in the financial markets, where changing investor psychology is recorded in the form of price movements. If you can identify repeating patterns in prices and figure out where we are in those repeating patterns today, you can predict where we are going. So what does an Elliott wave principle look like? Elliott waves are the basic building block of the wave principle. These Elliott waves link together to form larger versions of those same patterns. They, in turn, link to form identical patterns of the next larger size, and so on. In markets, progress ultimately takes the form of 5 Elliott waves of a specific structure. As you can see in the illustration, waves 1, 3, and 5 actually affect the directional movement, while waves 2 and 4 are counter-trend interruptions. The 2 interruptions are a requisite for overall directional movement to occur, and though there are several variations of Elliott waves, all of them fit into the basic structure. The stock market is always somewhere in the basic 5-wave pattern at the largest degree of trend. Because the 5-wave pattern is the overriding form of market progress, all other patterns are subsumed by it. So how do you begin applying the Elliott wave principle? Of course, by starting at its most basic level. The Elliott wave principle works by identifying patterns in market prices. So in other words, we start by analyzing waves on a chart. Elliott's pattern consists of impulsive waves and corrective waves. An impulsive wave is composed of 5 subwaves. It moves in the same direction as the trend of the next larger size. A corrective wave is divided into 3 subwaves. It moves against the trend of the next larger size. To use the Elliott wave, you must first identify 2 things: if the dominant trend is bullish or bearish, and second, which wave you are currently on. To spot Elliott waves correctly, make sure to follow the 3 basic and unbreakable rules. Wave 2 should never go beyond the start of wave 1. Wave 3 cannot be the shortest among waves 1, 3, and 5, and wave 4 never overlaps with wave 1. So in applying the Elliott wave principle, our first task is to look at charts of market action and identify any completed 5-wave and 3-wave structures. Only then can we interpret where the market is and where it's likely to go. But while applying the Elliott wave principle to any chart, we must keep in mind an important point. The Elliott wave principle does not provide certainty about any one market outcome. Instead, it gives you an objective means of determining the probability of a future direction for the market. At any time, 2 or more valid wave interpretations usually exist, so it's important for any investor or trader to carefully assess the probability of each interpretation. And that's it on Elliott wave principle. This time, I will be talking about annual cycles. As you might expect, the annual cycle, also known as the seasonal cycle, typically lasts about 12 months. Since it has a longer frame, anything can happen in the span of 12 months. We can have a sell in May, January effect, and ghost month. Sell in May and go away refers to a well-known statement in the business and financial world. The phrase refers to an investment strategy for stocks based on the theory that the stock market underperforms in the 6-month period between May and October. In contrast, the period between November and April sees much stronger stock market growth. If investors follow the strategy, they sell stocks at the start of May and have the proceeds held in cash. Then, the investors would invest again in November. By adhering to this strategy, the investors would avoid holding stock during the summer months. The January effect is a theory which says that every December stock prices take a dip and every January they receive a boost. This is driven by heavy selling during December and aggressive buying during January. Investors tend to sell off low-performing stocks at the end of each year. They then tend to buy those stocks back a few weeks or even days later. The January effect is driven by tax planning. Investors sell off stocks at a loss before the end of each year to try and mitigate their upcoming capital gains taxes. Once the calendar rolls over, they buy those stocks back to hold for another year of hopeful gains. Every year as the August comes, people in the stock market become fearful of the ghost month. Many advise avoiding investing during this time as it is considered bad luck. When wealthy Chinese investors are busy with their tradition and institutional funds become less active in the market, stock prices will tend to have a sideways or downward movement. For traders, this is a time to be cautious. But for long-term investors, it's a good time to buy, especially blue-chip stocks that went down due to this temporary weakness in the market. That's it for my live report. This is Dana, back to the studio.
Thank you, Dana. For more news, we'll be back after this short break.
There is nothing like a true friend. Someone who's going to be there by your side to give you a hug or be a listening ear to, and those friends I found eventually. At first, when I went to school, I would try and act a little more cool, say some cool words and change my hair and the way I looked, just trying to attract attention. If you're trying to look for attention or people who like you for how you look or how you act, that's not really a friend. What you need is someone who will accept you just the way you are. I don't need to change you, and I don't want you to change me. I just want to be friends. I want to help you to be the best you can be, and I want you to help me be the best I can be. That's the difference between wanting to have someone just because or actually finding friendship.
And we're back. You're still watching DRRM 106 News. Up next is the Head and Shoulders, not the shampoo, and lots more. Let's get to know them. For this report, we have Ronald. Ronald?
It's me again, Minette, and yes, we are not talking about the shampoo, but something more complicated. Let's talk first about the lunar cycle. A lunar eclipse occurs when the moon passes through the Earth's shadow. In our next slide, the research investigates the relation between lunar phases and stock market returns of 48 countries. One of these is the Philippines. The findings indicate that stock returns are lower on the days around a full moon than on the days around a new moon. The data show that the lunar effect is independent of the other calendar-related anomalies such as the January effect, the day of a week effect, the calendar month effect, and the holiday effect, including the lunar holidays. Next, presidential election cycle, especially in the Philippines. According to the Constitution of the Philippines of the 1987, the election is held every 6 years after 1992 on the second Monday of May. We have our system, the first past the post voting system. It is used to determine the winner of the election. The candidate with the highest number of votes, whether or not one has a majority, wins the presidency. If two or more candidates wins the most votes for any position, the Congress shall vote from among them which shall be president or vice president. We also have the business cycle. Returns may be affected by the phases of the business cycle. Consumer discretionary and industry sectors tend to outperform in the early cycle. Let's talk about the Head and Shoulders, not the shampoo, but the chart pattern. A Head and Shoulders pattern is a technical indicator with a chart pattern described by 3 peaks. The outside 2 are close in height and the middle is the highest. A Head and Shoulders pattern describes a specific chart formation that predicts a bullish to bearish trend reversal. The Head and Shoulder pattern is believed to be one of the most reliable trend reversal patterns. We will also be talking about the double or triple top or bottom. A double or triple top or bottom pattern is a reversal pattern. It means that the market is expected to decline after a rising trend or rise after a bearish period when these patterns are forming. The double and triple top or bottoms are different in both the way they form and the way traders should interpret them. The fact that the market is hesitating at a specific level is indicating a possible reversal to form. However, multiple tries at the same level is not a sign of a strong reversal pattern, but a sign of continuation. Most likely, a triangle is going to form, and the previous trend will resume after the triangle completes. We will also be talking about the triangles. In technical analysis, a triangle is a continuation pattern on a chart that forms a triangle-like shape. Triangles are similar to wedges and pennants and can be either a continuation pattern if validated or a powerful reversal pattern in the event of failure. There are 3 potential triangle variations that can develop a price action carves out a holding pattern, namely ascending, descending, and the symmetrical triangles. We will also be talking about the flag. A flag pattern in a technical analysis is a price chart characterized by a sharp counter trend. Flag patterns are accompanied by a representative volume indicators as well as price action, which signify trend reversals or breakout after a period of consolidations. We will also be talking about the pennant. Pennants are continuation patterns where a period of consolidation is followed by a breakout used in technical analysis. It's important to look at the volume on a pennant. The period of consolidation should have the lower volume and the breakouts should occur on a higher volume. Most traders use pennants to conjunction with other form of technical analysis that act as confirmation. Next is the wedge. Wedge patterns are usually characterized by converging trend lines over 10 to 50 trading periods. The patterns may be considered rising or falling wedges depending on their direction and have an unusual good track record for forecasting price reversals. We will also be talking about the gaps. Gaps are spaces on a chart that emerge when the price of the financial investment significantly changes with little or no trading in between. Gaps occur unexpectedly as the perceived value of the investment changes due to underlying fundamental or technical factors. Gaps are classified as breakaway, exhaustion, common, or continuation based on when they occur in a price pattern and when they signal. This has been Ronald reporting live.
Thanks, Ronald. And that's it for today's hottest and latest news.
This has been Ronald de la Serna.
And this has been Nanette Kibido saying goodbye, Philippines.
Goodbye, Cebu!